Welcome to another Disruptive Discourse video. This is episode 4 of my weekly review of what Ark Invest bought in the week. For those of you who are fans of Ark Invest, like I am, you may know that every week Ark Invest releases a list of stocks purchased and sold for their ETF. And if you didn't know that, but you're interested in seeing that list, then check out episode 1 for how to get access to it. What I do in these episodes is to analyze each and every one of those stock purchases on a weekly basis. As you would expect, Ark Invest actively manages a portfolio of ETFs, which means they are always buying and selling stocks, including adding and reducing the size of existing stocks. Now, for the purpose of this channel, I only analyze those stocks that I have not previously reviewed. Otherwise, these videos would be much longer and less focused than it needs to be. I'll signpost you to my earlier reviews if I have already done a review on a particular stock. So this week, I'll be analyzing 9 new stocks purchased between November the 2nd and November the 6th. And as is customary on this channel, I'll look at who they are and what they do, what growth potential they have, and my personal view on the stock. But before we get to those, let's list out the repeat purchases done in this week of November the 2nd to November the 6th, which I've already analyzed in previous videos. They purchased additional shares in these stocks that I reviewed in episode 1. Fastly, $5.7 million. And in episode 2, Repair Therapeutics, $0.05 million. Slack, $28.6 million. And in episode 3, Open Door, $5.8 million. Accolade, $0.9 million. Teladoc, $68.5 million. Exact Sciences, $57.7 million. And Spotify, $44.7 million. If you would like to see my analysis on those stocks, then feel free to check out those videos. The link will be in the description box below. Now on to the new stock purchases. The first is Unity, ticker symbol NYSEU. Ark Invest purchased $9.2 million worth of shares in Unity on the 2nd of November. Unity's CEO is John Riccitiello. This isn't in fact the first time that Ark Invest has purchased this stock. With this addition of 62,000 stocks, this brings Ark Invest's total ownership in Unity to 835,000 shares, and that's now worth $95 million in the Ark Innovation ETF. Unity is another stock that I'm personally very bullish on, and it is one of my largest positions. This company is big in the gaming industry. It provides the platform upon which game developers build their own games. In fact, most of the games built today are built on one of two platforms, Unity and Epic's Unreal Engine. Games like Call of Duty Mobile, Pokemon Go, Activision Blizzard's Hearthstone, Cuphead, and my personal favorite, Monument Valley, were all built in Unity. In fact, more than 50% of the top 1,000 mobile, PC, and console games were all built in Unity. But Unity isn't just about gaming. It is tapping into a growing market called real-time interactive 3D, which has an endless set of use cases. And here is a video explaining the potential market opportunity for Unity and why I'm very bullish on this company.
I love video games. I learned how to program a game by myself because that was my dream job. And I was using Unity as my game engine. When I realized that I can use this technology to work in one of the most rigid and traditional industries. And now we are changing the automotive industry.
I heard of Unity real-time tools. When was the first time?
Video games. It was amazing, like that's super powerful. Now it's pushing different industries in the non-gaming sector. The automotive industry is quite advanced in using real-time 3D. Now we can use a game engine to put the whole car together and being able to collaborate together. At Volvo Cars, we're challenging the current processes and pushing the boundaries together for the future. Yeah.
With Unity, it's like a movie, and a movie is fun to watch.
By using the same tool, we're able to speak the same language. So you can experiment with the complete virtual vehicle and make changes before we go into prototyping and production phase. Volvo's vision is that by 2020 nobody will die in a new Volvo car. By using real-time technology, we can expose our engineers that work with safety to different scenarios. We also use Unity for machine learning training for self-driving cars. We train the models to recognize different objects because we don't want to gamble with real people's lives when we are testing those scenarios.
Unity, it's the bridge over the pain points. That's how I see it, to make life easier.
Unity is drastically changing the automotive industry and changing the way we work. Which is a big deal.
Now, Volvo is just one of its customers in the non-gaming space, and you can bet that the customer base will grow significantly over the years to come. As for its growth prospects, according to Unity's S1 filing with the Securities and Exchange Commission in the US, Unity stated the following: "We see significant opportunities to grow our business. We believe today we address a total market opportunity of approximately $29 billion across both gaming and other industries." Unity's revenue grew from $380 million in 2018 to $540 million in 2019, which is a 42% year-over-year compound annual growth. With the $29 billion a year market opportunity ahead of it, you can bet that this company will be growing fast. As I've already stated, I'm invested in Unity, and it's quite unusual for me to invest in an IPO, but there is so much upside with this company that there was never any doubt in my mind that I will be invested in this company going forward. The next stock is Workhorse Group, ticker symbol NASDAQ WKHS. Ark Invest purchased $1.5 million worth of shares in this stock on the 2nd of November. The CEO is Dwayne Hughes. Workhorse is an electric truck manufacturing company with drone integration for last mile delivery, which sounds pretty cool. Now, before I go any further with this, let me preface what I'm about to say on this company with the following. One thing you may have noticed about my reviews of companies so far is that I'm not a cheerleader for Ark Invest in that sense. I love Ark Invest and their philosophy, but that doesn't mean I would agree with every single investment that they make. So I'm not afraid to be critical of any company, regardless of whether they are bought by Ark Invest or not. And the simple reason is that I want to be as objective as humanly possible. Now let's get into it. I have seen a lot of videos talk about the USPS contract, which is United States Postal Service contract, and that this would be a real catalyst for growth for the company, especially if they secure that contract. Workhorse themselves point to various other contracts signed or in the process of being signed, such as the 500 truck purchase order from Pritchard Auto Company. Add to that its 10% stake in Lordstown Motors, said to be worth $285 million after Lordstown merged with a SPAC called Diamond Peak under the ticker symbol RIDE. Now, all that is well and good, but I'm still left scratching my head with this company. The company has been a publicly traded company since 2010, so it's been around just as long as Tesla has. In 2015, it started the production of its first generation vehicles but took a pause in 2017. It went on a hiatus for a couple of years and then came back last year and has only managed to produce 2 of its Generation 2 vehicles as of August 2020. And yes, you heard me right, just 2 vehicles produced all of this year up to August 2020. And then the CEO suggested that it would produce 300 vehicles for the rest of this year. Then we hear from its most recent November third quarter earnings release that it is unlikely to produce anything even remotely close to 300 vehicles. Now, let's take a look at its revenue. It will come as no surprise that its revenue was $565,000. But worryingly, the cost of goods sold was $2.8 million. Now, I'm willing to give growth companies a pass when it comes to making net income losses. That's because I don't really expect them to generate net income in the short term throughout that growth process. But what is really critical is that a company has to be able to demonstrate that it has a strong business model, which would mean that it needs to be able to cover at least the cost of production of goods. Therefore, this negative gross profit margin thing that's going on at Workhorse, that's a major worry for me. And what that tells me is that they are nowhere near being a mass vehicle production company. They also set their production target for the financial year of 2021 at 1,800 vehicles. And nothing that the company has done so far tells me that they could even make half that number. They've only made 2 vehicles this year. Well, that is certainly what they've disclosed, and by my calculation, that's a $2 billion company making 2 cars a year. If you think I'm exaggerating, take a listen to this interview with the CEO conducted in August of this year.
In reality, we delivered our first vehicles in March of 2015, and we delivered our Generation 1 electric vehicles through December of 2017. At that point, we, took a pause and paid attention to our customers, did a lot of learning over the experience of having those vehicles on live duty routes, the 6 million miles I mentioned before on the road. And we were able to really identify what the electric vehicle of the future really is for our commercial fleet customers, primarily in the parcel delivery space and the last mile delivery space altogether. So since our redesign, which I see you showing on the screen there, and identifying things such as the weight of the vehicle. For example, a combustion engine step van that's used for parcel delivery today, they weigh about 11,000 pounds before you put the first package in it.
Right.
What we identified was the ability to reduce that weight would allow us to right-size the battery pack, give us a better opportunity, as well as our fleet customers an opportunity to have a stronger ROI and a total cost of ownership savings. And so taking on the things that differentiate us, such as those weight savings, have given us an opportunity to now move into production this year, where we've already delivered the first 2 of our Generation 2 vehicles. And we're really loading up, if you will, to deliver primarily in the fourth quarter of roughly 300 vehicles this year, on a backlog of roughly 1,200 that we have currently and continuing to grow.
So you've delivered 2 vehicles so far. You aim to have 300 by the end of this year. Is that
correct?
Okay.
Correct.
Now, I don't want to be too negative on the company, and I can see that there's a good reason why Ark Invest would have invested in this company. And for me, I would say it's because this is just a speculative bet on the company. And if the company does pull through all of these difficulties, which I really do hope they do, then you could see that there is a lot of headspace for significant growth for the company. And therefore, I have no problems in Ark Invest investing in this company, given that the recent purchase is only $1.5 million, which is a small amount for Ark Invest. I will keep an eye out to see how they do with their production next year. They have partnered with Hitachi to help them improve their production capacity, so we'll see how that pans out next year. But for now, it's a no-no for me. The next stock is Iridium Communications, ticker symbol NASDAQ IRDM. And Ark Invest purchased $2.3 million worth of shares in the company, and the CEO is Matt Desch. This is another great company that Ark Invest has unearthed. It has done what Elon Musk's Starlink is in the process of doing, which is to put a constellation of satellites around the Earth's orbit, 66 to be exact. Its business model is, however, different to that of Starlink, in that it is a business-to-business model to help support Internet of Things in the aviation and shipping and other hard-to-reach places for communications and logistics. Here is a video that explains it better than I can.
Iridium is more than just a satellite company, making connections anywhere, to anything, or anyone. With an upgraded, state-of-the-art constellation, complemented by decades of experience, Iridium brings new energy and a forward-looking vision to the industry. There's no other network like it. Operating in low Earth orbit, Iridium is still the only commercial satellite system where calls and data are passed from satellite to satellite. The network provides low-latency, weather-resilient services to the whole planet. Safety and reliability are in Iridium's DNA. Trusted by people and organizations in some of the world's most challenging environments, Iridium remains committed to helping make the world a safer place. And Iridium continues to innovate beyond satellite phones. The flexible Iridium Certus platform provides voice and data access at the fastest L-band speeds available. Iridium is also enabling the technology of the future, from real-time tracking to command and control for autonomous systems, and simplifying IoT application development beyond cellular networks. And all of this is made possible through Iridium's growing ecosystem of over 450 industry-leading companies around the world. As we look to the future, the possibilities are endless.
This company has already done the hardest part. Now, with all that low Earth orbit real estate at its disposal, you can bet that the company is set to see a growth in its revenue for years to come. Whilst its revenue growth has been a moderate 9% compound annual growth over the past 3 years, the hidden gem behind all of this is that it has only just completed this satellite constellation and they went online just last year, so the growth is definitely coming. I see a lot of upsides with this company without a shadow of a doubt. The next stock is Honeywell International, ticker symbol NYSEHON. Ark Invest purchased $3.7 million worth of the stock on the 2nd of November, and the CEO is Darius Adamczyk. Let's not beat around the bush with Honeywell. This is not a growth company and it's not about to get a second wind of super growth cycle. But nevertheless, I actually love this company and their management is, in my view, on point. Honeywell can best be described as a conglomerate. It's not a business that's focused on one area in particular, but rather it has a various number of arms that cover anything from aerospace to business architecture to PPE equipment. It's literally that big and dynamic, but it's not an industrial company like 3M or Boeing. It's a tech company. Yes, that's right. Honeywell is actually a tech company for the industrial sector. Its tech prowess is such that it's even made the most powerful quantum computer to date. But what I really like about the company is how it continually adapts its business to the times, and it's already keen on buying disruptive companies. It recently purchased a business that produces flying autonomous unmanned systems powered by hydrogen cells. That makes perfect sense to me because there currently aren't any batteries that can power large aircrafts given the distance that those aircrafts have to cover. And in my view, hydrogen fuel cells are a viable and logical alternative to traditional fossil fuel powered engines, especially in the aerospace sector. Here's a video that showcases the extent of the company's technological reach.
The world's changing. Automation's growing. Productivity's soaring. Innovation's accelerating. At Honeywell, it's a familiar story. Because we've always adapted to be changing the way the world works. developing more efficient processes, devices, and systems for vital industries. Today is no different. We're leading the charge as industry undertakes digital transformation, developing software, services, and the digital solutions that set the pace for an ever-changing world. Now we detect toxic gas by listening for it. Build predictive analytics that maintain jets while they fly. Streamline e-commerce with artificial intelligence. Connect and transform massive buildings with advanced software. Safeguard critical infrastructure with intuitive cybersecurity. And create experts in field repairs through augmented reality. Honeywell continually promotes its culture of creativity, speed, and agility. To be ready for anything. To change everything. To change the way the whole world works.
As I said earlier, this is not a growth stock. It has a revenue of around $40 billion per year, with a respectable price to earnings ratio of 28. As a useful comparison, the PE ratio for the S&P 500 is currently sitting at 36. So it is cheaper than the average 500 companies listed on the S&P 500 today. And that is definitely good enough for me. Moreover, the company is heavily investing into future technologies. And so I see this as a great company to be added to any portfolio, and it pays a dividend, so what's not to like? I would be adding this to my dividend portfolio. The next stock is Alibaba, ticker symbol NYSE, BABA. Ark Invest purchased $11.2 million of the stock on the 3rd of November, and the CEO is Daniel Zhang. Alibaba needs no introduction. It is one of the trio of the Chinese FANG stocks, otherwise known as the Chinese bat. And as you may or may not know, Jack Ma is no longer the CEO of Alibaba. In fact, he is no longer the majority shareholder of Alibaba. The only thing that he is retired from Alibaba, courtesy of the People's Republic of China. Enough said about that. Now, I could spend the next 5 minutes rambling on about what Alibaba is, but I'm sure my audience is much smarter than that, so I'm not going to patronize you. Instead, let's take a look at the revenue this company has generated. In 2016, it generated $15 billion, and by 2020, this has grown to over $70 billion, which is an almost 50% compound annual growth rate. That is an impressive growth rate for such a big company. No wonder they got rid of Jack Ma. And talking of Jack Ma, he has gotten into more trouble with the People's Republic of China, and his much anticipated IPO of the Ant Group has literally and metaphorically been quashed. But I wouldn't feel too sorry for Jack Ma. At the end of the day, he's still a billionaire. So why did Ark Invest buy shares in Alibaba during this week of November the 2nd to November the 6th? Well, the only news I could see is that there was a sell-off in the BAT stocks due to the Chinese Communist Party unveiling regulatory plans to root out monopolistic practices within the Chinese internet industry. So perhaps Cathie Wood decided to take advantage of that for both Alibaba and Tencent, which I will discuss below. But interestingly, the average price of the stock has since gone lower following the November 3rd purchase. So investors are clearly worried about this antitrust action by the Communist Party. The truth is, this is more of a power play between the Communist Party and billionaire entrepreneurs like Jack Ma, to let them know that the Communist Party is still in control. Alibaba makes up a small part of my portfolio, and I will probably keep it that way for now, as there still appears to be some downside momentum which could present an even more attractive entry point for the stock. The next stock is PayPal, ticker symbol NASDAQ PYPL. Ark Invest purchased $124 million worth of stock on the 3rd of November. The CEO is Daniel Schulman. This was Ark Invest's largest purchase this week by a country mile. Again, this is another stock that doesn't need any introduction. PayPal is of course the first payment processing company to try and disrupt the legacy financial institutions. It's the owner of Venmo, which is an app-based peer-to-peer payment system. PayPal has just announced that people can now purchase Bitcoin directly on its platform, following the lead of Square. I very much suspect that this is the reason Cathie Wood has now gone all out bullish on PayPal. Not that she wasn't already bullish, I should say, but now even more so with this news. I'll leave you with this very thought-provoking discussion involving Cathie Wood and Dan Tapiero as to why Cathie Wood is so bullish on Bitcoin and as a consequence bullish on Square and PayPal.
Basically took a look at 10 years worth of data, all of the assets that are available to institutions, and the managed assets at that. So those that are actually managed by third parties. And that's about 110 trillion in the world. So a 10-year study, in order and using correlations of returns and all of the usual metrics, determined that in order to minimize the volatility of putting Bitcoin in the portfolio and still enjoy the return, I think that was a 2% position. If you wanted to maximize the return and were willing to accept more volatility, that would have been a 6.5% position. And the punchline, and this is going to be years away, but if that 6.5%, if institutions were to hew to that 6.5% in Bitcoin, that would, all other things equal, knowing what we know about the supply out here, and the fact that more than 50% of all the Bitcoin holders right now have held the Bitcoin for more than a year, and many for more than 5 years. Just so you have to take that out as a supply constraint. The number he came up with as a price target, and I don't want this plastered all over headlines and so forth, because this is just if, lots of ifs there, is $500,000.
Oh, wow. By what? And did he have by a certain time period, or just if these things happen?
This will happen gradually. And believe me, we're talking about the institutional world. These sorts of things happen quite gradually.
It's just not too crazy. I mean, the market cap of Bitcoin now is, call it 300 billion. If you understand what the security apparatus is, that is the Bitcoin network, and you sort of contemplate what that kind of network is actually worth to the world, I mean, you could easily say it's worth 2, 3, 4 trillion. It's certainly worth more than one company in the NASDAQ. And so, gold guy, and being a hard money, someone who understands hard money, the jump to Bitcoin is easy. What's difficult is to understand what exactly Bitcoin is. And so you have to go and you read the Satoshi white paper and you say, okay, that solves the Byzantine generals problem. Okay, and why is that important? And then you say, oh my gosh, he turns electricity into security. Bitcoin is a security network, right? That's the genius of this thing, that it's, so it's actually, Bitcoin is actually a lot more than just gold. Gold is a store of value, but it's not programmable. There's no Lightning Network on Bitcoin. There's no, digital asset ecosystem. I mean, I think that the real opportunity of Bitcoin is much, much greater than just digital gold. So, and as Cathie mentioned before, there's a whole world of companies that are growing up in what I would call the digital asset ecosystem, that are enabling the usage and transaction of cryptocurrencies. There are, early stage sort of applications of blockchain technology that are relevant. The Bitcoiners hate that word. I just think that the Bitcoin and the technology that's behind it, or the invention, of Satoshi's, and what it actually is just much bigger. And so I'm very bullish gold. I think we're in the early stages of a bull market. I think the gold price will double. But as Paul Tudor Jones says, Bitcoin will be the fastest horse. I think Bitcoin can go up 20 to 30x as gold doubles.
PayPal has a 17.3% compound annual growth between 2016 and 2019. There is still much of the financial industry to be disrupted, and only time will tell if both Square and PayPal pull it off. If you ask me, I think they would, because they're doing things that the main financial institutions willfully turn a blind eye to. This move into blockchain technology is inevitable, and PayPal and Square are already on that train. I'm bullish on both companies and will be looking to add more shares to my currently small allocation at some point in the future. The next stock is Tencent, ticker symbol OCE TCEHY. Ark Invest purchased $63.6 million worth of Tencent on the 3rd, 4th, 5th and 6th of November. The CEO is Ma Huateng. This is the third of that BAT stock combination, famously known for the WeChat app, which is a super app that doubles up as a payment platform, social media platform, and much, much more. Tencent is also a huge player in the gaming industry. It owns Riot Games, which is one of the biggest esports companies out there. It has an 84% majority stake in Supercell, which created Clash of Clans, and it also owns a 40% stake in Epic Games, which owns Fortnite. On top of that, it is the number one fintech company for payments, number 2 for cloud services, and so much more. Personally, in my view of the BAT stocks, I think Tencent is the real winner here, and it's likely to be the stock that sees the most growth in its revenue over the next 5 years. It has grown at a rate of 36% year over year for the past 4 years. Again, impressive numbers for such a big company, but it is yet to be seen whether these new regulations would have any major impact on its dominance in China and consequently on its growth prospects. I currently do not hold any Tencent stock, and it really has reached all-time highs even despite this recent pullback. The next stock is Z Holdings, ticker symbol OTC YAHOF. Ark Invest purchased $3.6 million worth of these shares on the 4th of November. The CEO is Kentaro Kawabe. This could be described as the Tencent of Japan. Under its armory is YHOO Japan. Surprisingly, YHOO Japan is a really successful business out there in Japan and is the main digital news and communications platform out there. It also owns PayPay, which is one of the biggest payments platform in Japan. So given the pattern so far of Ark Invest taking stakes in the BAT stocks, it makes sense to see them do the same with the Japanese version. The company has seen a 14% year-over-year compound annual growth. Not sure I'm brave enough to invest in a Japanese company given the past history of their stock market. I think I'll leave that one to Ark Invest. The last stock on this list is Lendingtree, ticker symbol NASDAQ TREE. Ark Invest purchased $37.7 million of the stock on the 5th of November. Now, the best way I can describe this company is that it's a credit intermediary between lenders and borrowers. Or better still, it's a price comparison website for mortgages, personal loans, student loans, and many other forms of credit. Here's a short video from the CEO giving some more insight about the company.
CEO and founder of Lendingtree, started it in 1996, moved to Charlotte in 1997, set up Lendingtree in my spare bedroom in Ballantyne, and we went and built the company from there. Our business is, we're an exchange between consumers and financial service providers to help you with comparison shopping across mortgage, home equity, auto, credit card, personal loans, now all types of insurance, also deposit products. Operate under many different brands, and then we also have a lifetime value business we call My Lendingtree, where you can set up an account, and then you only get alerts to improve your credit score or to save you money on your loans. In 2000, we took the company public. 2003, we sold to a company called Interactive Corp. We spun back out in 2008. and have been growing ever since. So this year we will be over $1 billion in revenue and 200+ million in earning adjusted EBITDA, and we've been growing like crazy.
The company is still in its growth phase and could be a decent growth company going forward. It has seen a revenue growth of 42% per annum compound annual growth over the last 3 years, and it would seem like there's more to come. This is certainly one to watch. Now, to sum up, and out of the list of these companies, and from a growth perspective, there is one real diamond in the rough, and another company that's just plain rough. For now, anyways. And the latter title goes to Workhorse, whilst the title of Diamond in the Rough goes to Unity, without a shadow of a doubt. Two more companies worth a mention in terms of growth potential are Iridium Communications and Lendingtree. As usual, if you've enjoyed this video, please like, comment and subscribe. And once again, this week has been an epic week for me in terms of my subscriber growth. This really means a lot to me, so a real big thank you to all my new subscribers. And for those new to the channel, please do subscribe, as that's the best way to reward me for all of the work that I put into these videos. As always, like, comment and subscribe, and thank you once again. I'll see you in the next video.